The opinions expressed by Peter Wexler, Robert Quitner, Kyle Plotkin, Michael Hart, Nicholas Hamner, and guests on this show are their own and do not reflect the opinions of this network. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Investment advisory services offered through Brookstone Capital Management LLC, aka BCM, a registered investment advisor. BCM and Franklin Retirement Solutions are independent of each other. Insurance products and services are not offered through BCM but are offered and sold through individually licensed and appointed agents.
Welcome to this week's episode of Solving the Retirement Puzzle, and I am overly exuberant for some reason, and I don't know why, but I am Nick Hamner, and I am your host this week, as I am every week, and joining me this week, as always, are Mike Hart and Kyle Plotkin. Give the title cards enough time to go under. We've got a lot to talk about this week, so we're going to dive right into our content. First thing I want to talk about is every do-it-yourselfer thinks they have a good grasp on what they're doing, right? It doesn't matter what they're trying to do. They think they've got it. It's the human condition. We all think we're better drivers than we are. We all think we're better handymen than we are.
I don't pretend to be a better handyman than
No?
I am. No. I know my limitations.
I realize I said that as I'm sitting across the table from the two least handy people I have ever met. Mike, which end of the screwdriver do you hold?
It depends.
Depends on if it's a screwdriver or a hammer that day.
Mm-hmm.
But yeah, so everybody has this idea that they are competent, that they are good. But we know that oft-touted theory, and I think there was a study to back this up, although the study's been torn apart over and over and over again, that you need 10,000 hours to properly master something. So I did the calculations because I was curious, and you have to chalk some of this up to human nature. Let's say you practice something for 2 hours a day. That's every day of the week, no stopping, no, not doing it for vacation, no, not doing it because you're bored. Every day, 2 hours of intensive practice on something.
So 14 hours a week, we're saying.
14 hours a week. How many years does that translate to?
5,000 days.
Mm-hmm.
So, like, I can't do math today.
That is
15 years, 18 years, 17 years?
13.7 years. So call that 13 years, 8 months, thereabouts. So let's temper that back a little bit. Let's go. Okay, I might can give 1 hour a week. 1 hour a week of dedicated practice. How many years is that?
Well, it's double what you just gave, right? So
No, times 14 because it's 1 hour a week. So we said 2 hours a day. So multiply that
sorry.
by...
I thought he said 1 hour a day.
Yeah,
not 1
so
hour
that's
a
like
week.
100 and something, 170 years.
No, that's 27 years. So 1 hour a day is
So it is 1
27.4 years.
hour a
Yeah.
day, not 1 hour a week.
No, no,
Well,
I've
you
got.
said 2 hours a day, and now you're saying 1 hour a week.
No, I said 1 hour a day because week comes next. I did weeks and days too.
Good thing we're numbers guys.
Yeah. Good thing we don't
Okay,
work
yeah,
with
so it
numbers
is
every
it
day.
is
So
double the previous number.
if you could dedicate 1 hour a day, if you went outside, let's say you wanted to be a better golfer, and honestly, at this table, we could all stand to be better golfers. If you wanted to be a better golfer, you wanted to master golf, and you went outside and swung straight for an hour a day, that's 27.4 years of golf practice before you became a master of your swing.
10,000 days.
Yeah. Sounds like a Tool album.
Kind of.
I think it is a Tool album. So let's go even more into what we are more likely to do. Because everybody who says they're going to go to the gym every day might crawl in 2 times a week. So
January 8th, they're done.
yeah. Usually by February 10th is the longest most people make.
I used to work for gyms. January was by far the busiest
Oh
month.
yeah, it's busy as all get out, and then February crickets.
Hmm.
Hmm.
Does Planet Fitness still do the pizza on Fridays?
No, they do not. Used to do bagels and pizza. They don't do that anymore. Do they have the lady in the weird sweatpants who's sitting at the bench the entire time you're there playing on her phone? Yes, they do. The old guy who is stronger than you would ever think he would be on the leg press machine, still there. The guy lifting in a proper romper, still there. You thought rompers were a fad? No. There's a dude just tearing up the gym every Saturday in a romper.
For 10,000 days straight.
Well, no. So if you get it for once a week, if you could practice once a week, 1 hour a week, how many weeks? How many years is that?
A lot.
If you practice 1 hour a week at something, you're going to be working for 192 years before you master it.
I was gonna say roughly 200 years, but yeah.
How many times you go to the driving range after that lesson you took?
Once. How many benefits did I see from that one lesson?
-10.
Well, at least this way I don't have to mark my golf balls. Because now, like when we golf, Kyle plays with Pinnacles. Mike, you're playing with the red Callaways.
The Callaways, yep.
I'm going to play with whatever ball is 30 yards to the right of the fairway and covered in grass and leaves. So it's easy to tell us apart now. But yeah, so even if you could manage 2 hours a week, that's still 96 years. So figure then guys that think, oh, great, my library gives me access to Morningstar. I can spend this much time really learning how the markets work, really learning what my funds are going to do, really learning this. Who has 2 hours a day to spend on this? So figure at best you're getting 1 hour a day if you really want to be honest. 1 hour a day, 27.4 years. So if you start at 40, and let's be honest, let's start at 50. If you start at 50 to really focus on the market, to really focus on your finances, to really focus on what your retirement plans are going to be, that's 27 years. That's age 77.
That's damn near life expectancy.
That's pretty much it. Yeah. What's life expectancy
Yeah,
today?
I think it's
83.9?
slightly-
Something like that.
Yeah.
And still,
And your 1 hour isn't going to be a good hour, right?
No.
Because this is after you get home from work, after the kids have gone to, T-ball.
Right.
Like you're worn thin, and now you're starting this process.
and they've come out and said, so Malcolm Gladwell is who brought this study into prominence and brought this whole idea of 10,000 hours. But he went back to the people who conducted the survey, and it's not only spending 10,000 hours, it's who's giving the instruction. If you have a good teacher, that's great. If you're teaching yourself, that's not a quality 10,000 hours.
Well, because perfect practice makes perfect. Imperfect practice just makes you more imperfect.
Well, yeah. I
Thank
was
you,
gonna
Zig
say,
Ziglar.
I do what I can.
think about all the people who, like, not practice necessarily, but have certainly put in 10,000 hours of rounds of golf,
Mm-hmm.
and we know from being on the course, none of them, including
So,
ours, we're not masters.
right.
So,
So that's just to be competent, really. And then, but you're practicing one thing. So you're okay, you're good at golf. What happens if you get in a situation you're not comfortable with? All of a sudden, if you don't have good training, all that's out the window. So no matter how much you read about what your portfolios are supposed to do, all this Morningstar research you get for free, all this combing of Yahoo Finance, even if you pay, that the quality is not where it needs to be. And so if the situation turns, all your training, all this studying you've done, you're still at risk of losing. And how much time then do you have to recover?
Well, what's the disclaimer you see everywhere when it comes to investing? As past performance doesn't guarantee future results.
Which is just a more polished professional version of, while these plates are not predicted to rise in value. Other plates like them have. That the Franklin Mint used to always do.
Yeah. Yeah.
That's why every grandmother of a certain age has the Wizard of Oz plates on their wall.
Yeah. Well, like your Steve Garvey baseball card from 1987 is probably not worth a ton of money anymore.
Right. Goose Gossage, maybe.
Perhaps.
Mike Schmidt, we
I
hope.
was gonna say, yeah.
But my Ken Griffey Jr. rookie card, that 89 upper deck, really launched the series. Just going to give that to my daughter when she's ready for college, and I'm going to send her off to go pay for her tuition and use the rest on a spaceship.
What's it worth? What are they worth now?
Well, the last time I looked, which would have been 1991, it was worth $47. Now you figure compound interest, and surely baseball cards have not decreased in value. I'm sitting on a cool couple million just in that card.
Easy.
Yeah.
Easy.
Now couple that with like a Frank Thomas rookie card and maybe the Billy Ripken error card, 1989 Fleer. All the money in the world. But no, that's what I've got. So really, you can't, unless you have good quality instruction, unless you're being tested on what you're learning and forced to improve, you can't rely on what you think you've learned. I think is the moral of this story. And we all quietly know that, even though we'd like to think we're better than we are at certain things. I would love to tell people I'm a better golfer than I am. And then I go out on the course and I prove that no, I am not a golfer by any stretch. I'm a better snack provider than I am a golf ball hitter. I would not base my career on my golfing knowledge. I would not base my career on my ability to hang drywall and tile over it, even though I've done that several times and have plenty of experience doing construction. I would not hang my hat on that. So I certainly wouldn't, without the qualifications I've received already and continuous study that I do, I would not base any retirement advice over what I've been able to gather for free by reading the newspaper and reading the internet and using the free financial resources you might be able to get through your library or wherever. You have to work with a professional, even if it's just to get that second degree of liability, somebody that's responsible and can act faster than you can should something go wrong. So that's the moral of my story. And if you're not working with a professional, if you think you're doing pretty good by yourself, but maybe you want a second opinion, maybe you're quietly thinking, yeah, I don't know what I'm going to do. Stuff like that, that's what we're here for. That's what we do. So I want you to reach out to us at info@franklinrs.com or give us a call at 215-657-9200. And I'm curious to see what you guys have, because we started this off with you two arguing over who was actually going to present it. I guess you both had the same idea.
Yeah, well, great minds think alike, and
Is that what they say?
yeah,
Who is they?
I don't know if we ever figured out who they are, but
They is always nebulous.
Is it?
Oh yeah, it was they.
Is that an actual person, or is
did
that
it.
just a
They did
Marvel
that.
supervillain?
Nebulous. Yeah,
That does sound like a Marvel supervillain.
Yeah, it does. It does.
they talk a lot, don't they? They do. They certainly do.
Mm-hmm. All right, so we'll settle this. We'll let Kyle go first, and Mike, you got to scramble. So what are we doing, Kyle?
No, Mike took it. I
Oh.
actually switched it up at the last
So you actually
minute here.
fought. Okay, so we did this at the last minute, so this is going to be well researched and smooth.
Well, the article I have is well researched. So what I have, this is from the Wall Street Journal. A stock market rotation of historic proportions is taking shape.
Okay.
And so what we're saying here is, last week in the stock market, if anybody was paying attention, was pretty weird. Pretty weird. Nvidia and all the other tech stocks that have been going through the roof for the past several months lost a bunch of money. And the smaller cap stocks, specifically the Russell 2000, which is 2000 small cap stocks, which means that they are less than, what is it, 3 billion in market cap, I think, something
right.
like that. Over the past 7 days through this past Wednesday, so a couple days old, but still relevant. They outperformed the S&P by the largest margin during that length of time since 1986.
And we say that, and we say it's outperforming the S&P, and we're inferring that it was largely the tech stocks because, as we've talked about in previous episodes, Nvidia, all these big ones have been driving the S&P, and because the S&P is weighted, a large part of the S&P is represented by these big swingers that we've
Yeah,
had.
so the Magnificent Seven
Hmm.
stocks that people keep talking about, they were driving market returns. For example, Nvidia, as of I want to say last week, uh, 30% of the S&P 500's growth this year so far was just straight up from Nvidia. So obviously, if those turn around have a bad stretch, it's going to affect the market in general.
But
So
right now we're seeing little guys doing well.
what we are, which is a change.
Hmm.
Part of that they say is interest rates, because what happens is when there's economic uncertainty, you look to the bigger, more established companies. You figure, okay, these guys, Coca-Cola is going to be fine,
Right.
pretty much no matter what happens. People still going to drink soda. Uh, but with the Magnificent Seven stocks, that's kind of where everybody went. That's where the growth is. That's where all the talk is. Yada yada. Well, they reported in the first quarter of this year a 52% increase in their profits. The other 493 stocks in the index declined by 8.7% on
Yeah.
average. For the second quarter, analysts expect a 28% jump in earnings for the Mag 7. The rest of them they expect to be down 1%. So again, it doesn't show the full breadth of the market. We're talking about a small handful of stocks that are pretty much driving everything.
Yeah.
However, there are these Russell 2000 companies, which again are the small cap stocks.
Hmm.
They are expected to report nearly an 18% rise in second quarter profits, snapping a 5 quarter streak of year over year declines. So part of that, what they're expecting is interest rates. Okay, so think about this. If you have a smaller company, say they're like a newer company or, you know, somebody that's trying to grow,
Hmm.
what's one of the things that you need in order to grow your company?
Got to have bank money.
You need to be able to borrow money. If interest rates are super low, you can borrow money for next to nothing. If interest rates are high, it's harder to borrow money. Not only are the rates going to be higher, it's harder to get loans and things like that.
Hmm.
We've heard all kinds of stories about what's going on with banking right now. So, um,
Well, I just remember post 2009, the hoops you had to jump through just to get any kind of commercial paper. Banks were not coming off their money. They got so stringent after having been so loose.
yeah, that's still happening. It's still very hard to get approved for mortgages
Mm.
and things like that on the individual level. But one of the things with lowering interest rates is that there's a theory out there, and this is largely true, I think, according to history generally, is that the smaller cap companies are going to do better when money is easier to get.
Hmm.
So because these small cap stocks have been doing frankly not very well at all for the past year, couple of years, if interest rates come down as they're expecting these small cap stocks to kind of turn around and do a bit better. Last week was a good example of that. I think part of that was they had an inflation report that came out where inflation was actually down for the first
Right.
time in forever. So yeah, there may be a shift in the market happening. You know, could it be just a 1 week blip? Yeah, sure, it could be. We won't know that for a little while still because these are all backwards looking measures. But something to be aware of that it is being talked about, it is being looked at, and it's certainly being felt across the market. If you had money in your 401k, most things there are in some kind of index fund. You were likely down last week. Um, if you had money in small caps, you were probably up last week. So again, it's a big change from where the trends have been over the past, at least years, probably a couple of years, but something that we're keeping an eye on because that certainly would be a shift in the style of investment that are doing well as opposed to other styles of investment.
What are your things? What are your thoughts there, Mike? What are your
Yeah,
things?
no, absolutely. I mean, you think about the companies the small cap companies that have taken out loans or lines of credit and have been paying on those now for a few years. When those interest rates drop, they're going to refinance that debt. Those payments are going to be lower. That means they're either going to have more working capital or just more profit because less of their money is going to go to servicing that debt. So, yeah, absolutely. And that's, we've seen in the beginning of the year when they were saying there's going to be, what was it, 14 rate cuts or some,
Yes, 7, I think it was
yeah,
some crazy
some
number.
high number, and now we're saying one, maybe none, because maybe one in September, but maybe not because they don't want to do it before the election.
And
But
that's why you saw large cap stocks go crazy first half of the year, especially in tech.
yeah, so yeah, I mean, having to spend less money to service that debt, which most companies need to run the business day to day,
Yeah.
can only help the bottom line. So
Yep. So there could be a rotation in the market happening. We won't know for a while until we kind of see what their results end up being. But there's early indications that that could be happening now.
And still very little action on the corporate bond side.
I mean,
well,
with rates as high as they
yeah,
are, it's nobody really wants to pay those. Nobody wants to issue bonds with rates that high because then they're going to have to pay those higher rates. They're going to wait till
Yeah.
rates come down, because if you're going to have to pay 8 or 9% interest and you wait a year and it might be 5 or 6, why would you do that? You're going to hold off on issuing those bonds unless there's some dire reason why you need to do it now.
yeah. If you believe rates are going to go down, then you're gonna wait as long as you can before you borrow that money.
It's that inverse relationship we all love to talk about. Fun, fun, fun on the corporate analysis world. Just just mind-blowing engaging stuff when you start digging into the details like that.
Oh, it's incredibly exciting.
Oh yeah. I am thrilled that we got to discuss something so
Gets
engaging.
your heart pumping every
Yeah.
time.
Right down in the cockles.
Mike, so the topic that you stole from me.
Yeah, just listen. Thanks for
Wait,
this.
I do the segues. I am the segue machine over here.
You're dragging your feet.
Yeah. Mike, on the article you stole from Kyle.
Yeah, no. Thanks for the inspiration. It
That's how
was,
you do the segue. That's how you segue. All right.
I did all the highlighting myself for the highlights.
We know your
The
highlighter's been in the
article.
camera shot this whole time.
But so Vanguard did a survey of people who roll over their old 401k money
Mm-hmm.
to IRAs, and what they found is that almost a third of all people that roll money from a 401k into an IRA, that money just ends up sitting in cash.
Yeah.
So, you know,
Very common mistake.
most, we've said before, 3 out of 4 years the market's up, and then 1 out of 4 years the market's down. So most of the time, having your money in cash is going to cost you. And Vanguard actually looked at, what those numbers actually mean. So, uh, Americans with cash-heavy IRAs give up more than $172 billion a year in retirement wealth
Now, is
by
this one of those
keeping.
lost valuation projections like they always do? You know, the final four is going to cost American companies 600 billion from employees watching, loss of productivity estimates. Or did they really figure how much cash is currently sitting, how long it's been sitting? Like, did it say
I think they're.
they did a hypothetical?
I think they're taking the adjusted inflation adjusted rate of return from the stock market going back to 1922. So it includes the Great Depression, and the
Mm-hmm.
inflation adjusted return for the stock market for that long period of time was 7%. So, or just around 7%. So I think what they're doing is they're looking at cash balances and saying, okay, if you earned 7% adjusted for inflation,
Mm-hmm.
here's how much money you're leaving on the table.
That actually, I can speak from personal experience. That did happen to me as well.
I did that with in an old job. The the company that handled the 401k plan was aggressive in me getting out of the 401k. They were, I mean, I had been out of there almost 2 weeks and they were on the phone. We need you to roll this out.
The, yeah.
And
Yeah,
I
and
put,
there's compliance, and if they can get you sort of off their books,
mhm.
then
Well,
Yeah.
I did, I put it into a Merrill Edge, which was easy to set up. But when it came time to distribute, I thought I had distributed, but it wasn't like, a big, easy to use point and click. Well, this one's this fund, this one's this one. It was a drop down box and it was just single line text description, names of the accounts, not our names of the positions, not even what they were, what their record was. There was no way to research anything. It was just this massive drop down list. And so I thought I clicked one, hit apply, hit save, moved on. No, I had it sitting in cash for 3 years until I realized.
Same thing happened to me. The 401k at an old job was in Vanguard, and this was like, I don't know, almost 20 years ago now.
Mm-hmm.
But the 401k was in Vanguard, so they wanted me to get it out of the plan. I put it into a rollover IRA at Vanguard, and again, it ended up in the cash account. So I didn't even think about it. Didn't
Mm-hmm.
even dawn on me for like 3 or 4 years. And oh, I have this money still. And I went, and the market was up some crazy multiple, and the money was still sitting there in cash. So at least it was safe and it didn't lose anything.
Right.
But I lost out on a whole bunch of growth that could have potentially been there at the time. Had I understood what was happening at the time. I wasn't in this industry at that point, so I didn't really know a whole lot personally. And B, I just, I was more worried about other things, trying to find another job at the time,
Yeah.
etc. And it just gets lost.
Yeah, it's one of those things where, you can transfer, IRA to IRA. A lot of times that will transfer in kind. So you're not selling the positions and then transferring it. But with 401ks, more often than not, they're selling all your positions and then cutting a check either to you or directly to, the new custodian.
Yeah, I think the only way that they don't do that actually is if you have company stock and you do what we call an NUA, or a net unappreciated, what was it,
Yeah, you got it.
net unappreciated assets, something like that. But basically, it's kind of a loophole where if you have highly appreciated company stock, you can actually get some tax advantages by transferring that in kind. But it's fairly complicated transaction. Not many people know about it. Not many people do it. But I'm pretty sure that's the only way you can get money from a 401k into another type account without liquidating it to cash.
Yeah.
Yeah. So it's something you really want to be cognizant of because you can cause yourself. They give an example in this article of a couple who had rolled over an old 401k. They had more than $400,000 that was rolled over, and it just sat in cash. And just in the course of 2 years, had that money been in the market, they would have made an extra $100,000. That over the course of just a couple of years, that now that they've lost the opportunity to make that money. And that's just one of the things we talk about all the time, and you talked about. It takes 10,000 hours or more to master a subject or to master a skill. You know, if you come in here and you meet with us, even if you come in for 3 or 4 meetings,
Yeah.
you've spent less than 10 hours, and you're getting professional advice.
And you'll have a professional in charge of it. Yeah, that goes a long, long way. It's the difference in trying to retile a bathroom yourself versus having a guy who's done it for 20 years come in and do it.
Yep.
It's
Or even worse, having that guy come in and fix your mistake that you spent money and time to make the mistake in the first
listen,
place.
this feels like a personal attack.
I was gonna say, are we talking about a specific story?
Have I never shown you the pictures of my bathroom wall?
I don't think you showed me pictures, but you told me the story.
A week before my parents are coming into town to stay with us for 2 weeks, I notice a few loose tiles in the shower. So I was just, let me pry these off. I'll glue them back on, reseal the caulk. Reseal the grout. It'll be fine. I pull one tile, two come off. I'm like, okay, maybe there's more damage than I thought. Pull the other tiles that I knew were loose. And then, in a flurry of dust, rotten drywall, and severe expletives, the entire back wall of my shower comes off. Every tile from 6 feet up down is in my tub.
Mm-hmm. Yep, sounds about right. Yeah. Peter likes to give me a hard time because 2 years ago I bought a gazebo. I took my brother to Lowe's. I showed it to him. I said, "Do you think we can do this?" And he said, "Absolutely, I think we can do this." And didn't get it done the first summer. Just completed it this past weekend. So
Well,
you
as
know,
I've
it's
told you before, if you need help, just ask.
we needed
And I
more.
will not answer that phone.
We needed more help than we had any idea we needed. So
You know, if you ever need any help. call someone else.
But yeah, so the short version of this is, everyone likes to think they can manage their money themselves, but you know, pay attention when you're doing those rollovers that the money isn't just sitting there in cash. And even if it is invested, Nick, to your point, and we see this all the time, people will say like, oh well, my money's in Vanguard, so isn't Vanguard managing my money? Vanguard is holding your money. Whether or not they're managing it is an entirely different question. So
I'm going to look up a phrase real quick because this whole conversation has made me think about it. Yes. The Dunning-Kruger effect. Are you guys aware of this?
Yes, sir.
The worse you are at something, the more competent you think you are. That the better you get at something, the more you realize you don't know.
Yep.
I feel like that's very relevant today. In our conversation, and just, if you got in your car right now and tried to navigate from here to Walmart, the sheer number of people who think they're great drivers.
Yeah.
So on that note, feel free to give us a call at 215-657-9200. And until next week, we hope you have a great weekend and we will see you around. Thank you very much for watching or listening.